June 26th, 2024. Now, my one thought coming into the day was that we would probably trade either above yesterday's high or below yesterday's low. And the reason for that is that it was an IOI pattern on the daily chart. So, an IOI pattern, like we had, you can see this bar is inside of this bar, and this bar is also inside of this bar. So, it's an inside bar, and then an outside bar, and then an inside bar. And when that happens, generally, it's considered a breakout mode pattern. And when you have a breakout mode pattern, the market often triggers the setup. And considering the fact that this was a bullish bar, made it, I think, at least a little bit more likely that we were going to trigger above the June 25th high rather than trigger below it. So when you get a breakout mode pattern like this, it's often going to trigger. And an easy way to look at that is just go look, on the 5-minute chart. They're all over the place on the 5-minute chart, IOI patterns, and just go look at the past, I don't know, 150 of them. Look, we have one right here today, an inside bar, and then the outside bar, and then another inside bar, 51. They're kind of all over the place, and just look at them and figure out how many of them trigger. I don't know the percentage; it's probably pretty high. But anyways, I figured that looking at the daily chart, it's an IOI pattern, so we're probably going to go above this high or below this low. And since it was a bullish IOI, it was a little bit more likely that we were going to trigger above. And if you look where we opened on the day, we opened basically, not quite in the middle of the range, but we spent a little bit of time oscillating around the middle of the range because the market was trying to decide if we were going to get an upside breakout or a downside breakout. So pretty important to note. Another thing to note is bar one was a doji bar. When you have a doji bar on the open, the odds of a trading range day significantly increase. So when you get a doji bar on the open, you should be expecting the market to end up going a lot more sideways and expect a lot of quick profits, especially on the open. I was looking today. I don't always look at Globex. Kind of just depends on my mood. But I was looking at the Globex hourly chart this morning, and basically, this bar was forming. And basically my thought process was this was strong enough to get a second leg sideways down. So if we were going to rally, we would probably spend the first hour or two of the day going sideways. And then if we were going to get a reversal up, it would be then. This was pretty strong, but we're headed towards the bottom of the trading range, which is going to be support. And you know that this is going to be resistance if we get up here. But you can see we sold off up here because we touched this price as well, theoretically by the close up here, and then sold off sharply without testing back to this point. So that's exactly why we were testing back to that point over there. So bar one, doji bar, odds of a trading range day are increased. Opening around the middle of the day's range, what do bulls see? Bulls see this as a big pullback, and they want, maybe a leg one pullback, leg two measured move. It's not really all that great. I think the pullback's a little bit too deep. What are bears hoping for? Bears are hoping, although they know that this is a pretty tight channel up, they're thinking that if we start to get a rally, it might turn into some sort of lower high, and they could potentially get a lower high major trend reversal. What do I think is more likely? I don't really know. I thought that if we got down here, there'd probably be some sort of reversal up, but I thought it was pretty neutral. And that the higher we got in the range, there's increased the odds of a move down. So really what I was looking for on the open today was a small bull bar near the bottom of the range, somewhere down here. Or, we got a bigger bull bar today, but a smaller bar, ideally near the bottom of the range to buy and try to turn it into a swing up to yesterday's high, or some sort of bear bar closing near its low, maybe somewhere up here, and you could sell that hoping we get the downside breakout of the IOI. Bar two, disappointing follow through for the traders who bought above one, but no one's really buying above one. It's a doji bar. Bulls want to buy above a good signal bar, and they don't have one yet. So we have a disappointing bar on two. Theoretically, the traders who are scaling in during two might use the rally on three to get out above one, but I'm not really sure the buy above one was all that credible anyways. You're betting that the gap down was a bear trap, and if you're buying above one, and bar one was a doji bar, which is minimum follow through to the bears. So you're buying bear follow through if you're buying above one. Again, I understand the context of how strong the rally up towards the end of the day was on Tuesday, but I just don't think it's a very good trade. You can see bar three, some traders using it to exit any sort of long limit established, but I think it's more traders scaling in during two. And then you get bar four, a good bull surprise. It's possible we've seen the low of the day. It's probably reasonable to buy above four. and you're hoping that we get a really strong rally and really good follow through for the bulls. You're prepared that if we don't get it, you're probably going to try and get out of the trade. But you have to think about your premise if you're buying above a bar like bar 4. Your stop might be below 1, it might be below 2, but realistically, I think the correct stop, the quote unquote correct stop, is below 1. But realistically, it's probably okay to just put a stop below bar 4. Your premise buying up here is that we're going to get good follow through. And there's no way it should trade down below bar 4 if you are going to get that good follow through. So the traders who bought above 4, what are they hoping for? Probably pretty much an exact bar that looks like 4 and consecutive bull bars closing near their highs in some sort of rally to at least yesterday's close. And I thought the real target, yesterday's high. But you get a disappointing bar, tons of sellers at the moving average bar 5. Is it a good sell on bar 5? No, I don't really think so. It's more of, you could argue a low 1 short. I might argue that we got the gap down and a first reversal down on 2, and maybe it's some sort of low 2 short below bar 5. But either way, it's a bull bar. So there are probably going to be buyers below a bull bar, just a good general rule. Now, if you bought above 4, you see 5. Are you happy with 5? No. You wanted to see another really good bull bar. So what are those traders doing? They're using bar 6. The stop order bulls you're thinking of talking about right now, right, is the difference between a stop order bull and a limit order bull with this sort of trade. The limit order bulls might look at this and say, well, yeah, second reversal down, but there's going to be buyers here. There's probably going to be buyers at the 3 high if we get there. Since the bears who sold above 3 probably did a reasonable thing, it was not really a very good buy above 3, so we might have to get back to that high. And the bears who sold above here are disappointed in how strong bar 4 was. So they're going to use any sort of sell-off on bar 6 to buy back their shorts. But continuing what I was saying, though, about the stop order bulls who bought above bar 4, you're disappointed in bar 5. So while the limit order bulls, what do they want to do? They're hoping the market falls down here so that they can buy. But if you're a stop order bull who bought above 4, you're disappointed in 5, and you don't really want to be in the trade at this price. You could be a stop and a limit order bull, but if you're a stop order bull up here, you're probably just going to exit and try and just get out of the trade because the pullback could be fairly deep. And the limit order bulls are going to wait to step in until we maybe get to the 3 high, or I don't know if it was some sort of 50% pullback around that. That around the 50% pullback is also the 3 high, which is not a coincidence. But that's exactly where the bulls ended up stepping in, and we get a doji bar on 6. Now, if you bought, if you're long for any reason, 6 isn't all that thrilling of a bar. It's a doji bar. Bulls, it's a high 1 in their bull trend. We had a 5 bar micro channel up to the bar 5 low. So again, it was most likely that there were buyers below 5 scaling in lower. The bar 7, a big bull bar closing near its high. Do you buy above 7? Well, it depends what you're wanting to do with the trade and how you're willing to manage it. You can see we have a possible wedge, bar 2, bar 5, and potentially not quite bar 7. I wouldn't consider 7 the wedge. But if bar 8 is, exactly what it was, a big tail, then I think it's a credible wedge, 2, 5, and then 8. Obviously, it didn't end up being a good wedge, but there was a lot of interesting things going on with bar 7. For one, it did not close above this high. So the breakout point was the bar 5 high, and you can see bar 7 was not able to close above the bar 5 high. If bar 7 was able to close above the bar 5 high, it would be a confirmed breakout, and it would increase the odds that we end up getting a strong rally up. However, since it was unable to do that, since it closed directly at, it's not, it's obviously not as bad as if it closed a tick below, but it closing directly at the 5 high is disappointing. Traders wanted it to close above the 5 high to confirm the breakout. And you really don't want to see anything disappointing with this trade because the risk is relatively big. The channel up is really tight, and we've had a good bull bar here, and we have a good bull bar here. So there is a reasonable chance we end up getting a good bounce, just kind of a pop upwards on bar 7 for some sort of scalp at least. But, if we don't start to get it pretty quickly, a lot of traders are going to exit. So again, thinking back to the concept of follow through for traders, what do you want to see as your follow through if you're buying above 7? Well, you need to see a bar that looks at least like this, maybe even a bit bigger. And you're hoping basically we get a quick painless rally up towards this high. It's probably not going to happen. So traders know they're probably going to have to scalp out pretty close to break even. And as we got disappointing follow through on bar 8, that's a bear bars, right? So bulls wanted at least a doji bar so they could say they had some follow through. And the trade was already risky because it's a big bar and possibly the top of the trading range. Now you have the wedge, 2, 5, and 8. So a lot of the traders who see this, they're going to say, well, this is not what I wanted to see. And they're going to start to exit. And that's probably what caused the tail on 9. Do you buy above 9? No, I would not do that. I think if you're buying above 9, I get the argument. We're always in long and it's a bull bar, but look at these dojis. Doji bar, essentially a doji bar. Look at every single reasonable bull bar today. Bar 4, bad follow through. Bar 7, bad follow through. This is the worst looking bull bar out of the 3 of them. So do you think this is going to get good follow through? No, probably not. Instead, we get doji follow through. And when you keep getting bull bars with bad follow through, bull bars with bad follow through, what are bulls going to do, right? If you're a bull and you're long up here, what does this look like? Does this look like a bull trend to you? Or does it look more like a leg in a trading range? It looks a lot more like a leg in a trading range. And if this is a leg in a trading range where the bulls continuously are getting disappointed, what are you going to do? You're going to look at this and be like, well, we're pretty high up. If this is going to be a leg in a trading range and not a bull trend, the bottom of the trading range could be all the way somewhere down here. And I think I'm long in the upper third. So what do traders do? Well, I would argue that we had a wedge again, like I said. You could look at it as the spike, bar 4, and then hindsight, I think the channel, it's reasonable to draw the wedge channel, bar 5, bar 8, and bar 11. I think it's okay to do that. But real time, as bar 11 is forming, I saw wedge 2, 5, and 8, and that 11 was trying to get a breakout above the wedge. And instead, what did we get? We got a really disappointing bar on bar 11. Bulls wanted a bull bar closing near its high. Instead, traders were exiting at yesterday's close, and we get something disappointing. So what has been, the bulls who bought here were disappointed. The bulls who bought here were disappointed. So if bulls are continuously disappointed, you can see they're buying below bars. They're buying below bar 8. They're buying below bar 5. They're buying below bar 10. So the stop order bulls are consistently disappointed. The limit order bulls are the ones making money, which means it's probably a leg in a trading range. And that's why when we start getting up here, this was the last gasp for the bulls, where if they could get a big bull bar closing near its high, great, it's a breakout above the wedge. And instead it was disappointing. So all the bulls basically just said, all right, I'm done with this trade. And that's what causes the huge bear bar on 12. So while bar 12 is a surprise, it's the exact type of surprise that this context calls for, if you are going to get a surprise. And you can see bulls giving up causes that. Maybe a test back towards the open of the day. You can look at it as spike, bar 4, and then wedge channel like I drew earlier, or you can look at it as a failed breakout above the wedge. I don't think it really matters, but the thing that's important to note is, what is this, right? It's a tight channel. And what did I say about tight channels yesterday? On higher time frames, breakouts are tight channels. Tight channels are breakouts. So while on the lower time frame, it looks like, a couple of it looks like a tight channel, it's consecutive bull bars. So as much as we get a big move down on bar 12, there's probably still going to be a second leg sideways to up from the bull channel. By sideways to up, again, the bulls got their second leg sideways to up here, 15, 16, 17. You might not like it because this was your first leg, and if you bought up here, you basically just got back to your entry price. But that is the thing about second legs, is they can often just go back and test the entry price, hence sideways rather than up. Versus a second leg up, maybe this could be argued as the second leg up, where you were able to make a large profit. So 13, an inside bar, possible that 12 is a bear trap, but 13 unable to close on its high, and the context is not all that ideal. I think 12 is pretty big, and we probably need to let another leg sideways to down. And we did. Again, 14 does qualify as the second leg sideways to down, so 12, and then a pullback on 13, and you could argue 14 is the second leg sideways down from 12. More likely, I think that that we're going to go really sideways here than much further down, especially with 13 and how tight this channel is. Ideally, I'd like to see a reversal down from lower, reversal up from lower, or a reversal down from higher. 15, a bull bar closing near its high. It's an inside bar. I think it's a credible buy. I think if you're buying above 15, you could probably put a stop directly below 15 or below 12. But you're risking 4 or 5 points, and you're trying to get to yesterday's high, which is 10 or 12, or about 12 points. So you're getting better than 2 to 1 of your risk. If you use the stop below 15, you're getting 3 to 1. So it's probably pretty reasonable to buy above 15, taking a chance we break out to the upside of the 18-bar range. We haven't formed the 18-bar range yet on bar 15, right? But if we're going to get a rally like you're expecting us to, the next couple of bars should be bullish. So we'll probably get up here. So reasonable inside bar. Reasonable, you could argue higher low, double bottom from maybe bar 4, but I thought the math, the equation was pretty good. It wasn't a super high probability trade at all, but it was definitely reasonable. 16, follow through for the bulls, a tail on the top. Not as ideal as it could be, but it does close above the 13 high and is a breakout of some sort. 17, a lot of overlap with 16, and you can see we did test back to the 15 high. So that's something a lot of swing trades will not do. You can see over here, we never tested back to that high. We had a small open gap. And a lot of times, swing trades will not give you, if they're going to go, they will not give you that second chance to get in, like we did on bar 17. The reason being, it doesn't give you the second chance to get in. Traders are forced to chase the market all the way up, right? So here, the rest of the traders who wanted to be in could have bought. But over here, the traders who hesitated and tried to buy on a limit order after the follow through were not able to get in. So they had to chase the market all the way up, which is driving the market up further and creating more profit for the bulls who bought above here with less information. So 17, we have 3 straight bull bars, but bar 12 is a pretty huge bar. So, I'm not really sure that we're going to rally straight up above it. It's reasonable to think we're going to get to the upside of the 18 bar range because there's 1 bar left in said 18 bar range. But I'm not sure we're going to rally, like I said, straight up. So we might have to go more sideways. Additionally, on the open, whatever the swing trade is, 90% of days have a swing trade on the open. 60% chance the market's going to try and trap you out in some sort of way. 18 could be that some sort of way the market is trying to trap you out. You know that 15, 16, and 17 is strong enough for another leg sideways to up. So we might have to test back up to the bar 17 close. What do the bears see? Well, the bears see bar 12 as a trend line break, right? So here's your bull trend line, 12 trend line break. And they see a lower high major trend reversal. I think a lot of them, they might just see the lower high in general. But, I personally thought after 3 straight bull bars, I did not like how strong 18 was. Do you have to get up below 18? You definitely can. It's not wrong to if you're long, but I'm not totally convinced that you have to. I think you can still remain long. I might be wrong about that, but that's what I thought at least. Basically a big doji bar on 19. So disappointing for the bears, I think. If you had sold below 18, now on the close of 19, you're at your entry price, which isn't all that great. Something to note is that bar 19, so if you're a bull, if you wanted to probably see bar 18 immediately trigger and then reverse back up, the reason being you can trap bears, and then if it starts to reverse up, the bears might have to buy back shorts, and that would cause the bar to continue to rally. Instead, what happened was bar 19 rallied first and then sold off. The reason that's a lot worse is because as it's rallying, what are bulls doing? The bulls are selling out of longs. So what you wanted was for it to trigger below 19, reverse up, bears panic out, buy back shorts, and we get a rally. Instead, what happened was we started off with the rally, which sometimes is fine if the bulls keep buying. But when it starts off as a rally and then turns down, and it shows that the bulls are exiting their longs and they don't believe in the trend, and that's not a good thing. So that was an important detail on bar 19. But again, not all that ideal. Some bears sell the close of 19 because it's the same as the entry price for selling below 18. So if you sold below 18, you might be worried about a trap, but instead there was follow through. It wasn't great follow through, but it was follow through. So some bears just sell the close of 19, thinking that we're probably going to continue down. And now they have more information and they're getting in at the same entry price. 20, a bit of a surprise, but a good bar for the bears. Closing near its low, you can see we're selling off at the moving average relatively consistently. And then big follow through for the bears on 21. This was probably more of a scalp, though. We've had a lot of reasonably decent bull moves over the past day or two. So I thought the market was trying to rally. And again, I thought the context of the day supported us breaking out to the upside of the IOI pattern rather than to the downside. So big bear bar 21, but you can see traders were buying back shorts at the new low. So as nice as it was for the bears to sell, a lot of them you can see scalped with 5-ish points. And if you sell below 20, you're hoping 21 looks like 20 and you want a breakout to the downside of this. Instead, you get bar 21, which is relatively disappointing. Some bears might sell the close of 21, and if you get a bull bar like you did, you just get out. Probably not the most unreasonable thing to do, but I would not personally do it. To me, this looks like the bottom of a trading range, and we're probably going to have to test back up. And it was really disappointing that we did not close below the bar 1 low for the bulls or for the bears. 22, a huge bull bar closing near its high. Really strong for the bulls that this bar ended up being that good. And, if you think about it, I understand that there's, 18 through 21 is 4 straight bear bars, and that's disappointing. But it's reasonable to buy above 22, betting that we get to yesterday's high. You have really, relatively reasonable risk reward. And you know that, but the problem with it is that you know that we might go a bit more sideways first before we go up. Why? Because 18 through 21 is 4 straight bear bars. And when we get 4 straight bear bars, the market is oftentimes going to get the second leg sideways to down, which it did. You could argue 24, 25. And you can see, I'm not sure if this is going to work. Okay, so the bears who sold the close of 21 and sold, below 24 were not able to use 25 to get out. You would have had to, I imagine, sell the close of 24. And even then, weren't even filled. So rare for the trap to be this clear, and not let those bears out. But later in the day, I'm sure if you had scaled in. But anyways, so I was getting a little sidetracked there. 22 is a reasonable bar to buy above, and it's one of those simple trades where you buy above it. What's your premise? Your premise is we're going here. Well, where's your stop going to be? Well, it's probably the low of the day. So if your premise is that we've seen the low of the day and we're probably going to go here, it's reasonable to just throw a stop right here and put a limit order up here and just see what happens for the most part. Again, you can't be scared of pullbacks if you're taking this trade. You know that 18, 19, 20, and 21 were still a 4 bear bar spike, one of the stronger moves we've had so far today. So we're not going to go straight up. So follow through 23 is encouraging for the bulls, but at the same time, we're probably going to pull back. The bears who sold above bar 21 are probably going to be able to scale in on limit orders and make money. So it's reasonable to think we're going to get back to this high, but there might be buyers there. An inside bar, a low one, short 24. Bears want to argue bear channel here, and you're selling on a bear channel. It's a low one short, but it is on a bear channel. Generally in bear channels, what you want to do is sell a second reversal down near the moving average. And this is a first reversal down, so it's not as good as it could be. Additionally, if you look at it, this doesn't really look like a very good bear channel. We're getting way too many strong bull closes for this to be a reasonable bear channel. So I'm not really all that convinced that we're going much lower. And you get disappointing follow through 25. Sometimes what bears will do is the same kind of thing as they did over here, is they see 25 and they're getting an entry price around 24, and they know it wasn't an immediate trap. So sometimes they'll sell the close, and that can cause, you can see we got a micro gap here, 25, 26. Sometimes it'll cause a big sell-off on bar 26. That definitely can happen. But instead, we started to get the reversal up. So there's points to the logic you have to think about here. You know that you had to allow for a pullback if you were going to buy above bar 22, but how much is too much becomes your question, right? So if we continue to go sideways, at what point have we gone sideways for too long? And my thought process here was that if we, if this is a bull move, right, we still have really reasonable risk reward to the new high. You're risking 8-9 points trying to make 15. And I thought at least a 50-50 chance that we get there. So reasonably good for the bulls. And when I was watching 26 form, I kind of thought to myself, okay, if we're this low in a bull trend, because that's what you're doing, you're betting that this is a bull trend. If we're this low in a bull trend, we should be seeing signs of bull strength. Bull trends are usually their strongest when they begin, and they get weaker as they go, as most trends do, because as the information becomes more clear, the risk becomes larger. So what I needed a sign of strength out of the bulls for bar 26. So, you expect at least a bull bar closing above its midpoint. And you can see here, we closed above the moving average on bar 26. It's really important that bulls closed above the moving average on bar 26. It increased the chances that we were going to end up getting the rally up to yesterday's high. And at this point, I think once you see, 26, I don't know if I would quite move my stop to below 25. It's probably fine to do. But I think the better thing to do is to just see if bar 27 is a bear bar closing near its low. And, I could be wrong for doing this, but I like to add to my trades when my management becomes more clear. So for me, I did buy above 21 and I wanted to add to the position, but I wanted to wait for at least one reversal against me because I figured I was going to get it. And I wanted to wait for a clear sign that the market needed to go now. For me, that was bar 26. I thought that if bar 27 was a bear bar closing near its low, then I would just end up getting out below it. So as bar 27 started to form, I just bought at the market and waited to see what bar 27 looked like. Had it been a bear bar closing near its low, I would have just exited below the bar and waited for more information, because that's a second reversal against you and you don't generally want to sit through those. Instead, it's a bull bar closing near its high. It's, 27 is a good bar to buy above too, because you know that the bulls are, everyone knows this is the target. So the bulls are buying here, hoping we're going to get up here. And if we're going to do it, it's going to be a relatively quick move. The market's not going to go sideways for a super long time. I think when there's an obvious magnet, the market tries to go to it. And if you see a magnet and you think it's an obvious magnet and the market's not moving to it at a pretty rapid pace, you should be concerned that your magnet might not be as obvious as you think it is. So I thought buying above 27 and you just get out if you get a bear bar closing near its low. And instead we got 28. 28 is important that it was a big enough bar. It was a smaller bar for the vast majority of the bar, but in the last 30 seconds to a minute, it ended up getting bigger and closing on its high above the bar 18 breakout point. So really strong for the bulls that bar 28 ended up being so big and clearly closing above. If you had bought the close of 17 and those traders had scaled in, they're deciding that they still think they're correct and that we're probably still going up here. And when you're getting exactly what you need, here ideal bulls close above the moving average. Here ideal follow through bar. Here, again ideal follow through bar, close above this high, close above this, closing near its high, big enough bar, pretty uniform with bar 27. And that's exactly why you get the huge buy climax 29. Bar 29 is not a buy the close bar. Bar 29 is a profit taking bar. We have reached the magnet. Yesterday's high was the magnet for the bulls because of the IOI pattern. And so when you get up here, and again, when you get this big of a bar, just think about the risk. What are the odds that we're going to go all the way up here before we start to get at least a deep pullback? And the reality is the odds are not all that great. Today ended up being a trending trading range day, which is generally where you get a trading range and then a 4 or a 5 bar breakout and then another trading range for the remainder of the day. So that is what today ended up being. But again, like I was saying, when deeper explanation, that was just a sidetrack, but deeper explanation of bar 29, it's a really huge bar closing near its high. Yes, and it's easy to be tempted to buy the close, but it's the fourth bar in the buy the close, and it's a humongous bull bar. So more likely traders willing to buy a pullback. You're not wrong for believing that we're going to test back up to the bar 29 close. We definitely should, and end the bar 29 high. It's good that 30 triggered 29, which would trap in some algorithm bulls who have really, really wide stops and are willing to scale in, which is going to make the market go sideways to up, most likely. But 30, disappointing follow through because most traders, again, are using this to take profits. They're not using this area to buy more. It's not like worth selling anything up here, but again, I would not be buying. 31, disappointment. I think, maybe any trader who buys the close, if I was to think about it from the perspective of not an algorithm and an individual trader, one thing that's really critical to understand, it might not make sense, but just, try to spend a lot of time thinking about this, and that is that there's a difference between theoretical trades and actual trades. Theoretical trades are trades that algorithms can take. Things like, selling the close of bar 29. Some traders are, that's maybe not the best example. I'm trying to think. Well, whatever. We'll just take selling close 29. No actual trader should really do that after 4 straight bull bars because there's way too much risk. But some algorithms will sell the close of this bar knowing they can scale in 10, 20, 30 times, and they're probably going to make money. But the bull, if you're an individual trader, on the other hand, you're not going to scale in 10, 20, 30 times. So this trade doesn't really make sense for you. So there's a big difference between, the same thing with, small pullback bull trend days. You have to ask, well, who is selling against the small pullback bull trend day? How is it possible that traders are doing that? Some algorithms are doing that and making money because otherwise they wouldn't be doing it if they were making money. And the answer is they're selling against it because they can scale in hundreds of times. They have billions and billions of dollars, so they can just keep scaling into Emini contracts, knowing that for one reason or another, whatever their reason is for being for shorting, they're going to end up most likely making money. But those trades don't make sense for individual traders. So you have to, it's hard to do, but you have to start to, think about the difference between theoretical trades and actual trades, because what you might find is a lot of your entries are theoretically good entries, but you're managing them really, really poorly. So that might be, I think that's a big issue. 31, I think 32 is actually where I was, high one for the bulls, but really not all that good. It's a doji bar. After this, I think we need to go sideways for at least a couple of hours and get a couple legs sideways down. We're probably going to close the gap with this high, considering the fact that this is most likely a trading range day. We might even close the gap. You can see we closed basically all the gaps all the way down to here. So pretty good for the bears that we closed. We even got retested the bar 25 high. So a lot, again, gaps tend to close on trading range days. Buyers below 32, you can see not really worth taking the sell during 33. 34, an inside bar, maybe a high 2, but not worth buying. At this point, I usually just, after you get such a big buy climax like 29, you're hoping that we don't test back up to the 29 high just yet. You want to get a deeper pullback and then a test up to the 29 high. But unfortunately, you can see on bar 36, we tested back up to the bar 29 high. So what do bulls do? Maybe they bought the close of 29, scaled in at a 50% pullback of bar 29, and then they use the rally on 36 to exit their first trade with a or at break even, around break even, and their second trade with a profit. You can see, this is the whole thing. 26 through 29 is a buy climax, but bar 29 is its own buy climax. So the bottom of the most recent buy climax is a target, which you can see we ended up reaching. 37, an inside bar, high one. There's no way I'm buying that. I think we need to go, more sideways and more down before we get a reversal up. Generally, expect about 2 hours of sideways to down trading. 30, 38, a bear bar, bear outside bar. We might have to get back to the bar 37 close at some point later today. 30 through 37 could be looked at as a final flag for the bulls. And either way, if you don't want to call it a final flag, that's fine. You can just call it a tight trading range. But if it is a tight trading range, then we usually do test back into tight trading ranges. 40, follow through for the bears. So more follow through for the bears. We're probably getting a second leg sideways to down, but it's not going to be, it's not going to be some giant bear trend. It's pretty unlikely. The bears need to do more and get stronger bars. These bars have too many tails. 41, a reversal up, a good bull bar closing near its high. Can you buy above 41? Sure, but you have to have a stop, a measured move down. You probably have to have a stop down here and be willing to buy more if we trade below 39. And I would probably put a stop somewhere down here. And you have to be willing to buy more if we trade below 40. So 41, an inside bar, a high, you could argue it's a high too, but this might be strong enough to reset the market cycle. This was really bullish and should get a little bit more of a second leg than just 36, but 38, 39, 40 is pretty strong. So, you have to realize that if you're buying above this, it's probably going to go against you at least a little bit. 42, follow through for the bulls, but not all that good. If you bought above this and you were hoping that it wasn't going to go against you, you probably wanted a huge bull surprise and you don't get it. 42. Disappointment, 43, but probably buyers below 42, scalping out. And then 44, a bear bar, but buyers down here. Second leg sideways to up, 45 from 41, 42. You know that this was strong enough for a second leg up. And you can just look at it in general as what kind of corrections do moves usually get. They usually get two-legged corrections. So 38, 39, 40, you can say two-legged correction. Either way to think of it, it's kind of the same thing. You're just thinking about the opposite side, really. 46, a bear surprise, closing near its low, but this is a strong bar. This is a strong bar. This is a strong bar. This is huge. To me, this is a bull trend, and this is a bear channel. So I think that the channel is going to end up being a bull flag. 46 is a huge bar with huge risk, not worth selling. You're selling pretty low in a trading range. If you do sell 46, first off, you know that the 45 low is going to be a magnet because the bulls want to buy, it was reasonable to buy below 45 and scale and lower. So the bulls are going to buy below 45. They'll buy more below 38, and they're probably going to make money. 46 is a huge bear bar, but it's a huge bar with big risk, selling in kind of the middle of a trading range of the overall day. You might even be selling the exact middle. Let's see. The market does that a lot where it forces you to sell the exact middle. So not quite, but you're selling within a tick or two of the exact middle of the day if you're selling bar 46. When you're selling in the middle of a trading range, the probabilities are never as good as you want them to be. So selling the middle of a trading range with huge risk is not ideal. Doji followed through 47, and if you sold 46 and you see 47, you should be getting out of the trade, which is what happens on 48. This is not the follow through you wanted 47. You wanted to see another bar like 46, and you didn't get it 47, so you should exit, causing the rally 48. Wedge 30, 40, and 47, so reasonable to buy above 48. But 46 is really strong, so we might go a little more sideways rather than straight up, which means the market might go a little bit against you. What do you do with this information? Well, it means you should probably have a stop, a measured move down. The point of the stop, a measured move down, it's also a good thing that 48 was an inside bar, because if 48 is an inside bar, it shows that the market is contracting and it makes the breakout a little bit more likely. Are you going to let the stop get hit? Probably not. But the thing about buying above 48 is that this was really strong. So you're trying to allow for one more reversal down. Whenever you're using a wide stop, the measured move stop, I know I talk about it a lot, you're trying to allow for one reversal against you. So you see 49, follow through for the bulls, yeah, but closing below the moving average. We're probably getting back up to the 45 high, but it's a trading range day. So the market can still trade against you before we get up there. And you can see on 50, we traded below the bar 49 low and then rallied. At this point, once we get the reversal down and bulls bought it, I think it's okay to move your stop to the 47 low, because again, all you're trying to do with the wide stop is allow for a quick reversal against you and then hopefully get an immediate reversal back up. And the reversal did not end up going to the new low. So when you get the rally up on 50, it's probably better to move your stop to below bar 47. And then you get the rally up on 51. It's an IOI pattern, 49, 50, 51. It's important that the bears are keeping this below the moving average. So 49, 50, 51, not able to close above the moving average. Good for the bears. And 50 and 51 were both, you can see a lot of buying pressure, reversals up. So I think that a stop below 47 now makes sense, because if we get to that point, the bulls have already had a few chances and they're probably giving up. 52, difficult bar, failed breakout above the IOI and a bear bar closing near its low. So if you're exiting below 52, what are you scared of? You're scared that 53 is going to be a huge bear bar closing near its low. And instead, you get a doji bar on 53. So what are bears going to do? Well, a lot of them try to buy back their shorts around the 52 low, but a lot of them will just exit at the market. So if you sold below 52, they see 53 as bad follow through and they exit at the market, causing 54. Similarly, so I did take this trade, which is probably the reasons why I'm droning about it, but I thought it was really interesting. So I did buy above 48 with a wide stop, and I put my stop in measurement. And by the way, I do plenty of things in the market I'm not proud of, but I just liked how I managed most of this trade today. But I did buy above 48 with a measured move stop down. We got the follow through wasn't as ideal as I wanted it to, but I did move the stop. I exited below 52 because I thought there was risk that we end up getting a big bear bar, and this turns into a bear channel. When 53 was not what I was scared it would be, which was a big bear bar closing near its low, I put the position back on and used 54, and I scalped out a piece at the 45 close. I got out the rest in here. I think I should have scalped out more at the 45 close. Not all, but I think I should have. I think I exited like 30 or 40% of my position, and it should have been more like 60 or 70% because it's a trading range day. So 54, a big tail on the top because there are sellers around the 45 close and the 46 high, which is the sell climax high. You can see 55, we traded below 54, found buyers, but not really worth selling or buying. I think we're entering a trading range, and so it's better to just wait and see what happens. An inside bar 56, not really worth buying with the big tail on the top. I think we're going to continue sideways. An II pattern 56, 57. But again, I'd rather wait and see what happens. And disappointing, not really worth buying above. So, but breakout mode pattern, yes, but not worth buying above because bear bar, not worth selling below because, the day has overall been, I think, a little bit more bullish. And we're just in the middle of a trading range. So it's not really worth selling or buying anything. 59, a big bull bar closing near its high. Maybe an okay buy. It could be 3 pushes up, 1, 2, 3. It could be, I thought some sort of triangle forming. Probably not unreasonable to buy above 59. But you can see it never triggered on 60. Instead, we got a bear bar, which is an inside bar, and we got another II pattern. So 60, 61, inside pattern. When you get IIs like this in general, 50% chance the first breakout fails. And you can see we got the breakout at 62, but let's see the follow through. And you get disappointing follow through 63. I didn't like that 63 closed on the moving average. You can buy it, but I didn't like that it closed on the moving average. I was not trading, so that was the last trade I took today, and then I just decided to be done for the day. I should want to see if bulls made 5 points. I'm curious. No, they did not. They made 4 points. So the bulls buying of 63 were able to make 4 points, and they got 64. But now the risk is big, and the probability it's a little better probably, but it's not as great. Again, you have big risk now in a trading range and a micro gap down, and kind of a disappointing tail on top here. So we might go higher, but instead a lot of bulls just scalp out. 65, bear bar closing near its low, making 63, 64 look like a bull trap, reasonable to sell below the bull trap. You could argue, higher high double top with over here. I would say 1, 2, 3 wedge, breakout above wedge, failure. And so probably sellers or possibly sellers below 65, follow through 66, 67, 68. But again, just look at this follow through. It's not all that great. There are tails everywhere. So it's not as good as it could be. 66 was good, but 67, disappointing, 68, 69. There's probably buyers below 63 more than sellers. So again, a bit disappointing. And we ended up basically getting a buy the close rally. Bar 64 is going to be a magnet. It's a trading range day. So traders who sell Our traders who bought the close of 64 and are willing to scale in above a bull bar are probably going to make money. And we got a huge bar, 77, and then you can see 78 tested the apex. This is a triangle, right? And the apex of a triangle is going to be a magnet. And you can see that's where we ended up testing the apex of the triangle. Why are triangles magnets? Because triangles are inside bars on higher time frames. So you can see how the range is contracting when we form a triangle, and the range is also contracting when we form, inside bars like this, like 15. So it's the same pattern on a higher time frame. That pattern over there is going to be an inside bar. So for stop orders, I thought, maybe for this, these are not ideal. You have to be really quick to make decisions. 15 is probably fine. 18 is probably fine, but I wouldn't, I just didn't like it. 20 is fine, but you got to find a way to get out. 22, good trade. 27, 28 by the close. You're exiting on the close of 29. Probably a mistake to hold or just get out below 31. And then I thought 48 was fine. Maybe 63, but I thought 65 was probably one of the better sells of the day. And then, that was it. I wouldn't personally touch any of this. It's just too late in the day for me. On the daily chart, we triggered the IOI pattern on the daily chart. When you trigger the signal, the market often pulls back. So another reason why 30 not that great. When you trigger the signal on the daily chart, the market often pulls back before re-triggering it. So like I was saying, daily chart, it's an IOI pattern. We got the breakout above, but it looks like it's failing. It's not really all that great. We're pretty high up in the range. So I'll be interested to see if we get back to the entry price tomorrow, which would be right here, one tick above this high. If we end up getting to the, if bulls end up selling out of their longs or if they buy more. But we're definitely in breakout mode. We're going very sideways here. So, look for a bull bar closing near its high or some sort of failed breakout and bear bar closing near its low. The monthly chart, like I said, bulls trying to get as strong as close as possible. Daily review is over, but little rant on a stock. So I bought, and you can never predict like 30% moves in stocks. But if you just look at the monthly chart of Rivian, I mentioned it in one of my reviews, like, I don't know, a few months ago. But, when a stock, it's not going to get all the way back up here, but when the stock's down to $10, $11 and it has clear magnets above, like the 2023 December close and the 2023 July close, there's a reasonable chance that you're going to get there. Because think about it, if the stock is $10 and the odds, and it might go bankrupt, right? So there's a real reasonable chance that the company just goes bankrupt and you lose all your money. But if it doesn't go bankrupt, then it stands to double or triple, and you can make 3 or 4x your money, and it's less likely that it's going to get bankrupt. There's stats in Al's thing that I have them written down somewhere. There's some sort of stats on bankruptcy. So here they are. Once a stock falls below $5 and 90% from the high and 40% in one day, there's a 50 to 90% chance of bankruptcy. So this stock is not below $5. It's definitely fallen 90% from the high, but it's not below $5. And I don't know if it's fallen 40% a day. But anyways, even if there is a 50-50 chance of the company going bankrupt, if you were able to buy it lower, like whatever, $10, $11, then maybe 50-50 chance, you make 2 or 3 times your risk, and you only tend to lose about $10. So it's a pretty reasonable trade. And he calls these HODL trades, hold on for dear life, which is a good, because you just hold and you wait till the stock triples. And a lot of times you have to wait a lot of months before it happens. But you basically just wait till the stock doubles or triples or goes bankrupt. So yeah, I just think they're interesting types of trades, and I thought this was a reasonable potential candidate a little while ago for one of those sorts of trades. But again, I don't tell anyone to don't take trades on my accord. But I just thought that those kind of trades usually make sense for a lot of things. Again, I guess not financial advice. Your money, do what you want with it. But anyways, that's the day.